Hey guys, it's Rudy coming at you live from Palm Beach in Florida. It is May the 6th. It is Tuesday. Over the past couple of weeks or so, well, a couple of days anyway, if you had watched my previous videos, you would have heard me talking a little bit about VAR Energy. And what I want to do today is go a little bit deeper into VAR Energy and tell you sort of what I think is going on here. And then you can let me know in the comments what you think in terms of VAR. Like, is it a buy or is it a sell, or is it a hold, or is it something that you want to avoid? So it started off originally with me finding VAR as a result of a couple of interactions that we had on the channel and chats that we had. And there was the original question, what do you think of VAR Energy? VARRY is the over-the-counter ticker symbol. So I said, I don't know, but I'll take a look at it. And I have taken a look at it, and I actually like it quite a bit. Um, and this for me would be almost purely a dividend play. But I figured let's take a little bit of time and look at VAR Energy because you might be interested in it as well. If you are, great. If not, I won't bore you too much because I'll go through it quite quickly. So the starting point for me is because it's a Norwegian company. I went to the Norwegian Sovereign Wealth Fund, which you can look up. It's Norges Bank Investment Management. It's one of the largest sovereign wealth funds in the world. And basically, in a previous video, I covered some of the holdings that the Norwegian Sovereign Wealth Fund has in its portfolio, which is predominantly equities and some fixed income. And of course, VAR Energy being a Norwegian company would strike me as a sort of a shoe-in for Norges Bank Investment Management to also hold in their sovereign wealth fund. So one of my first steps was to contact the investor relations department and had some communications with Ida. And she replied and she said, Norges Bank Investment Management, NBIM, is restricted from investing in Norwegian listed companies. I guess it kind of removes any sense of impropriety or other circumstances where you have a sovereign wealth fund investing in a company that is publicly traded in that particular jurisdiction. So anyway, she said, Ida said, they are not a shareholder in VAR Energy. However, Norges Bank Investment Management is a shareholder in Eni Spa, ENI Spa, and they actually have quite a large position of $604 million that they have invested in Eni Spa. So I'm going to talk about that one in just a second as well, because it gives you a little bit of context into VARRY Energy as a potential equity buy for your own portfolio. So I mentioned at the start, over the counter, you can buy VAR Energy as VARRY. So if I show you some charts, follow along and you'll notice that the currencies may be different as I move from chart to chart. On this particular one, I'm talking about the over-the-counter stock that you can buy in the United States for $5.50 US, right? So US dollar over the counter. You can buy VARRY for around $5.50. Year to date, it's down 15.25%. Sometimes when it's down quite a bit, it's a buy. Sometimes it's down for all the wrong reasons. In the case of VAR, I think it's just kind of following the trajectory lower with the commodity prices that are lower. But you can see at the bottom here, it has a price earnings ratio of only 10. That's quite attractively priced because it's way below the S&P 500 average, which is about 15 or so. But here's the really attractive thing for me. So it's currently paying a dividend of 89 cents on a $5 stock. So 89 cents on $5.50 is almost 16% if you annualize that. So the annual yield, almost 16%, or, when you look at it sort of on a quarterly basis, you're getting about 4% per quarter. That's not bad at all. Now, if you had wanted to buy it for its most recent dividend, the ex-dividend date was May 5th, which was yesterday. So you would have had to own it last week to get the next dividend payout, which I think is paying out on May the 8th. I'm not sure. It doesn't matter because you missed it anyway. So you can potentially buy VARRY on a go-forward basis. Now, my son sent me a link to the transcript for their most recent earnings call. and the earnings call was April 23rd, so just a few days ago. So what I did is I read through the earnings call, and then just to double check my opinion, I went to Grok and fed the earnings call into Grok and said, please provide me with a summary, which I could then review just to make sure I didn't miss anything that was pertinent. So over the next 5 slides or so, I'm just going to highlight some of the things that popped out in terms of the earnings call that was most recent just a few days ago. So they reported strong Q1 2025 results aligning with expectations. In other words, kind of matching what the market had expected from them. And it remains on track for transformative production growth in 2025, targeting over 400,000 barrels of oil equivalent per day by Q4. Right, so that's quite considerable growth. We're going to take a look at where they're coming from in just a second. The company emphasized resilience and flexibility in navigating volatile market conditions, maintaining a robust financial position and attractive shareholder distributions. Now, the shareholder distributions, of course, are attractive because of the high dividend. But in order to pay that high dividend, you need a robust financial position. So let's dive just a little bit deeper. From an operational performance point of view, the Q1 production was 272,000 barrels of oil equivalent per day, BOE/D. And I just said they're targeting over 400,000 barrels going into the end of 2025 in Q4. Couple of other highlights here, and I highlighted in yellow just so I don't keep you too long. 9 projects are expected to add 180,000 barrels of oil equivalent per day at peak, driving 2025 production to 330 to 360,000 barrels of oil equivalent per day. That's the midpoint expected, and over 400,000 barrels of oil equivalent per day by Q4 of 2025. One of the projects, Zagato, discovery near Goliath, potentially adding up to 350 million barrels of oil equivalent with further appraisals planned, right? So they're also exploring and looking for more as they go. How about financial? Because this is critical, right? If you're paying a large dividend, you need to have a solid balance sheet. Cash flow from operations, CFFO, cash flow from operations, after tax was $1.3 billion. Driven by higher sales volumes and prices. And of course, they had a realized oil price during the quarter, which was significantly greater than where oil is trading today, because we see Brent and WTI kind of struggling to even get to $60 per barrel. And this was at $76 per barrel. So you can expect a little bit of a dip there going into the next quarter, unless, of course, energy suddenly spikes. Operating costs reduced to $11.60 barrels per barrel of oil equivalent, with a target of only $10. So the operating cost on a per barrel basis only $11.60. Capital expenditure, or CapEx, 595 million, with full year guidance of around 2.3 to 2.5 billion. That's not really changed, it's maintained. Liquidity strengthened with a $1 billion senior note issuance, right? So there's some debt on the book here. The $1 billion senior note issuance 4 times oversubscribed, so very popular. Net debt reduced, and leverage ratio of 0.8 times EBITDAX. Dividend of $300 million, confirmed with Q2 guidance at $300 million again, maintaining a 25 to 30% CFFO payout policy, right? Cash flow from operations, that is their policy in terms of maintaining and paying out that dividend. Strategic updates, one of the fastest growing E&Ps globally. Low break-evens, around $35 per barrel. So this is critical, though. We see in the Permian, many of the shale drillers have break-even points around sort of $35 to $40. So the break-even here for VARRY Energy is pretty good at $35. So even at an oil price of 55, you still have a $20 upside there per barrel, multiplied by the production, which of course is heading up towards 400,000 barrels of oil equivalent per day in 2026. Free cash flow break even is $40 per barrel of oil equivalent, right? So the free cash flow is critical as well, because that's where the dividend money comes from. They announced some rebranding, aligning with a major shareholder, Eni, which owns almost 70%. So this is the Eni logo, and you can see the sort of 6-legged dinosaur there, for lack of some artistic integrity. I'll just call it a dinosaur which they now use on the VAR Energy logo as well. So they did some rebranding in Q1 to more closely align themselves with Eni, right? So Eni Spa. Some Q&A highlights. So many of the analysts that were on the call asked many questions. Dividend sustainability, this one's a critical one for me because I'm looking at this specifically as a dividend play, supported by long-term production growth, low break-evens, and flexible capex. The company projects significant cash flow to sustain dividends, $1.2 billion per year, even at lower oil prices by optimizing their costs and project pacing, right? So you don't have to do everything all at once. They have some spare capacity at Goliath, and that's about another 30,000 barrels of oil equivalent per day. Extra potential, the capex flexibility. 70% of future capex is uncommitted. In other words, they can space it out if they wish to do so. They can scrap it or do it later. They can do whatever they want, allowing for adjustments to market conditions without impacting near-term production. They have some challenges, accelerating project FIDs, right? Financial impact decisions. Or financial people just love acronyms, right? Especially if they can use acronyms that the average person cannot understand or keep track of. They love using them because it kind of throws people off and say, like, this guy's really smart, right? It's just financial impact decisions, involves managing subsurface, commercial, and engineering complexities. That's true of most drillers, but standardization and momentum are mitigating these. The outlook. VARRY Energy is poised for significant growth in 2025, leveraging its high-quality NCS portfolio, cost discipline, and financial resilience to deliver value through production increases, exploration success, and consistent dividends, even in a volatile market environment. For me, the critical thing is this consistent dividend. When I hold an equity like this long, some stock appreciation is great. But at the end of the day, if I can sock away 15%, here I go again with my 15%, right? It's just math. A 15% annual return multiplied and compounded over 5 years doubles your equity position every 5 years. That's just math. It doesn't matter if it's VARRY Energy or anything else, right? So if I have another stock that pays a high dividend, think of something like Energy Transfer or Enbridge, for example. So let's say, just to make it real simple, let's say Enbridge pays me 7.5% as a dividend. If I also get upside on the stock appreciation of 7.5%, that's 15. If I can manage 15% every year and compound that and reinvest my dividends, I'm well up on the 15% and I can double my position every 5 years. The dividend policy is critical, right? So here it is. This is from their website. Material cash flow generation and an investment grade balance sheet, which they have, enable attractive and resilient dividend distributions. VARRY Energy's long-term dividend policy is to distribute 25 to 30% of cash flow from operations. So there's your CFFO again, after tax over the cycle, right? That's their dividend policy. And until further notice or change, that's how it is. That's what they pay out. And I'm comfortable with that. So for me, this is something that I would buy and hold in my portfolio, not forever, probably for 3 to 5 years once again, but at least probably for 3 years, and just sock away the dividends as they come in. Largest shareholders, so I scooped the top 15 here, but really, if you think about it sort of critically, only one of them matters, right? So, I mean, to be fair, Folk Etregt Fondet, man, my Norwegian's terrible, right? My Norwegian's almost as bad as my investment analysis. So just take it from where it comes, right? 4%, but any international, so any ENI international, 63%, right? So they hold most of the outstanding float, and they are by far the largest shareholder. The other thing that gives you a sense of comfort here is when you scroll visually down this list here, you'll see names like JP Morgan Bank and State Street, etc. That means some of the institutional shareholders have already done some of the homework for you. So you're not an island in this regard, right? So you don't even have to believe or trust any of the information that yours truly is sharing with you, because smart people have analyzed this and actually taken a position, right? So there's some familiar names here: UBS Switzerland, Citibank, etc., right? So let's take a look at Eni Spa. because this is one of the major shareholders of this is the major shareholder of VARR Energy. And in addition to that, Eni is also one of the holdings of the Norwegian Sovereign Wealth Fund, as I said right at the beginning. So now I'm looking at the euro ticker symbol here. So this price is in euro, no longer in dollar or in Norwegian kronen. And you can buy any SPA on the European market, any, ENI.mi, right? So if you've ever wondered what any SPA means, so ENI is an acronym, which, and here goes my Italian, which is probably just as bad as my Norwegian, but I'm going to try. It says Ente Nazionale Idrocarburi. Idrocarburi, which is Italian for State Hydrocarbons Authority, right? So Eni is the state's hydrocarbons authority in Italy. Any SPA. You can buy it for €12.72. It's also like VARR Energy, down about 14-15% year to date. Unlike VARR, which has a PE ratio of only 10, Eni is actually sitting at 16.5, right? So it probably needs to pull back a little bit before you can jump in and buy some Eni SPA if you're more comfortable with Eni than what you are perhaps with VARR Energy. Nice dividend as well, almost 8%, right? It's currently paying $1 on a $12 stock, so almost 8% on an annualized basis. Not a bad stock to hold directly, but I prefer VARR Energy for its dividend. Simply Wall Street a few days ago, in fact, the dates down there at the bottom of the screen, said VARR Energy and two other companies estimated to be trading below their intrinsic values. So this was as of December, right? And then it said over here, right at the bottom, I'm going to read the slide to you, but it says at the bottom here, the estimated discount to fair value is 23%. Well, when they actually posted this update here onto their website, Simply Wall Street, VARR Energy, now this time in Norwegian kronen, was trading at 34.98, and they said the fair value is about 44.59, right? So if we look at it in Norwegian kronen, so once again, I've changed currencies here, so NOK, you can buy VARR Energy. And now in Oslo, if you were to buy it, VAR, this is the Oslo exchange, you would buy it for 28.12 kronen. Now, I just said to you that at the time Simply Wall Street published this, it was trading at almost 35 kronen, and they said the fair value was about 45.59. So right now you can actually buy it on the Oslo exchange, or you can buy it on the US exchange as an ADR, which is an American Depository Receipt, for $5.50. But anyway, if you are able to buy it on the Oslo exchange, you can hold the stock and buy it for $28. So it's even less expensive than what it was in December, when Simply Wall Street said it was discounted to fair value at approximately 23%. So now it's at around 37-38% below its fair value. The only thing with fair value that you need to keep in mind is that it's based on a discounted cash flow, or DCF model, which has many, many assumptions in it, right? And sometimes when you make those assumptions, you don't know what the commodity price is going to be, or what other macro events might take place. You just don't know, right? So they're all based on assumptions. So the fair value in itself is kind of like an educated guess. So VARR Energy on the Oslo Exchange down 16%. As of December, that was the 35 kronen that Simply Wall Street was referencing when they published that particular report. You can see it came off a high of around 38 or so, so it's way below its 52-week range price. The PE ratio, as I said at the start, is 10. And of course, you have this beautiful dividend here, which in kronen is 5 kronen, which is 18%. So that's the distribution that you can rely on. If we take a quick look at the balance sheet, and I'm nearly done, then I'm going to wrap it up. And then you can tell me in the comments whether you think this is even worth holding in your portfolio at all or not. So I'm looking at the balance sheet, and if I look at December 31st, right? So now I'm already in May, so this is 4 months out of date, but it's the last information that we have available. And if I look at the current assets and I look at the current liabilities, this is not a good picture, because what I can do is I can express this as a ratio. And if I take current assets to current liabilities as a ratio, it gives me a 0.68. And I want to see 1 or above, right? So this is not a good number. They're flying too close to the sun, and they need to have significantly more liquid assets in their current assets column in order to give me a sense of comfort. But remember, as I said at the beginning, as long as they have the ability to offer me a sustainable dividend, I'd be less interested in the stock appreciation. I don't want my $5.50 buy to go to, $2.50, because that would just look awful on my portfolio. But these things happen, right? But at the end of the day, if I were to hold it at all, it's because I want to generate the income from the big dividend that they pay. So how about most recently, right? So I said that was as of December 31st. But if I go to the earnings call on March 31st and I take cash and liabilities, and accounts payable is basically short-term liabilities, right? So I can express this as a ratio as well. The previous one, when I talk about the total current assets to current liabilities, is called the current ratio. But if I look at the cash and compare it to the accounts payable, that's called the quick ratio. And now what I have is approximately 633 to 392, which is a ratio of 1.6. I'm much more happy with this one. And it's also more up to date because it dates back to just March 31st, which is just over a month ago. So that's a good one for me. So that's a beautiful picture of Norway. And of course, Norway is a magnificent country. And one of the reasons why Norway is so incredibly wealthy is predominantly because of oil and gas. So over the last 50 years, they've gone from being almost a developing nation to being one of the wealthiest nations in the world. In fact, on a GDP basis, they are for sure in the top 10, and they might even be in the top 3. But as it relates to VAR Energy, which was my original question, is this a buy, a sell, or a hold? And if it is either of those three, then you can let me know in the comments what you think. And maybe it's none of those three and it's just a void, right? So anyway, I look forward to people who are interested in oil and gas, and specifically VAR Energy, to share your thoughts with me. Obviously, not all of us are chasing dividends. Some of us are chasing stock appreciation, and some of us are chasing stock appreciation of 10 or 20x on some of the micro caps, right? But that's for you to decide and for you to let me know in the comments. So check in. Hope this was informative to at least some people. Let me know what you think, and look forward to interacting with you in the comment section. Take care. Thanks for watching. Bye-bye.